Good morning, aviators. My hair is all jacked up, sorry. There we go. All right, thanks for being accommodating this morning. I just figured that since we were going to do a midterm review, that it would be good to get it recorded so that if you want to go back and revisit this morning to earn full points back, you may. All right, I told you at the beginning of the semester that I don't curve, everybody gets their score, and we talked about flow through errors, right? Right. Most everybody did a great job. And if your score was not what you thought it was going to be, I would say 99% of you simply made one mistake. Okay. And then that one mistake carried through to like 5 other answers. All right. So we're going to go through the midterm, and then you guys will have a chance to ask any questions that you might have in order to resubmit for full points. All right. So if you got a 40% on your midterm, all right, which some people did, that was only a result of one mistake that probably flowed through to everything else. All right. So today we're going to go through and we're just going to kind of talk a little bit about where the mistakes typically happen. Right. Any questions about the midterm? Does anybody have any questions that they want to have answered right away before we get into it?
Can we submit, I'm sorry. So if we correct the midterm, like with the right answers today, like we just submit them right after class and we'll get the new grade like replaced with the old one?
Yeah, so I'm actually going to give you a week to resubmit, okay?
Okay.
So by next Thursday, after we talk today, you just need to, I'll have another folder open on Moodle that you can resubmit your midterm, and I will take the best of the 2 grades.
Yeah, okay. Yeah, that makes sense. Okay, thank you.
Okay. All right, sounds good. All right, my Excel is still firing up here. It doesn't seem to want to function very well at the moment. So let me just kill this real fast. Has anybody upgraded to the new like Mac OS, the Monterey?
Yeah, I did last week.
I did too, and it has really jacked up my computer.
It's so confusing. I did it to my phone too. I like updated everything all in one night and like made a new Apple ID, and now all my stuff is all messed up.
It's all jacked up. Like, I'm not happy. I'm not pleased right now. Okay. All right. Let's talk a little bit about where the majority of the confusion on the midterm kind of came. First of all, on the segregation between the balance sheet and income statement. All right, I'm looking at the midterm, so that's why I'm looking down. All right, for the most part, I'd say everybody pretty much nailed it. All right, on the balance sheet, the things that we own and the things that we owe, you guys were able to parse those out, and you were able to get to the total assets and the total liabilities, and then the net difference between the two was the net worth. Right, so I don't think that there was calculation errors, but I do think some of you just simply need to make sure that your math is working. You pretty much got all of the assets, right? But then you just didn't sum it up properly. Okay, that's not everybody. There's just a few folks that had that situation where you nailed it, but then you just didn't sum everything up the right way. So that caused a problem with the assets, which then obviously caused a problem with the net worth. So you lost some points on that. So you fix that, you get the points back. The big thing was, for those of you that lost big points on the balance sheet, remember, the balance sheet is an as-at financial statement, meaning as at a certain point in time, okay, we own a certain number of things that have value, right? We own a certain number of things that are assets. On the liabilities side, as at a particular point in time, we owe a certain amount of money to people who have extended us credit. So student loans, car loans, credit card payment, credit card loans, not the payment that we make, right? Remember, because the payments that we make, those payments that occur each month, that's not a balance sheet item. That's an operational activity. So that sits on the income statement, cash flow statement. Okay. So think about that as you go back to fix some of the issues that you might have had with the balance sheet. On the cash flow statement, income statement, everybody nailed like the gross wages and net wages. Really great job. And there were a couple of issues with isolating the fixed expenses and the variable expenses. Okay. Remember, fixed expenses are those expenses, all right, that don't change based upon your consumption. Okay, so think about your rent or your mortgage payment, right? Whether you spend every single night in your apartment or you don't spend any nights in your apartment because you're spending it with your boyfriend or your partner or whatever, your rent doesn't change. So your utilization does not impact, right, the cost of that bill. So things like your student loan payment, your car loan payment, your rent payment, right, internet, those are all fixed expenses. There were a couple of folks that kind of mixed up what is a balance sheet item and an income statement item, right? So some of you put the car loan, the remaining loan payment, down in your income statement, your cash flow statement. Well, that's not a cash flow statement item. The remaining principal is a balance sheet item. So you got to shift it back to the balance sheet. Okay. And then it looked like from the math that I saw, everyone figured out pretty quickly how to deduct all of the expenses to get to disposable income. But if you made one mistake, right, in placing a variable expense item up in the fixed expense item, that jacked up your total fixed expenses, right? So that was a deduction, even if you got the final disposable income number right. Right. So I take points off because that's how the math works, but now you have an opportunity to go back and fix it. Does anybody have any questions about like the balance sheet and the cash flow statement from the midterm? Because now is the time to ask. Okay. All right. The next big item that a number of folks seemed to have an issue with was question number 3, right? Determine the monthly payment Albert would need to make in order to achieve his goal. Assume he will be making an initial investment of $1,000 towards this goal. All right. So here's what I'm going to do. I'm going to share my screen and we are going to work through one of these problems with different numbers, but the exact same math. Okay, if this wants to work right now. Screen sharing has failed to start. Please try again later. Great. I'm telling you, this Monterey upgrade really messed things up. Okay. I guess we're just going to have to talk through this because the screen sharing is not functioning at the moment. Okay. All right. So what are we dealing with on this? What kind of Excel function are we having to talk about? What are we solving for? PV, FV, number of periods, rate, PMT, payment.
Is
Anyone?
it the payment?
Payment. We're solving for payment, right? So I'm going to see if I can't cut over to my iPad because we definitely need. Okay. Give me 30 seconds, guys. Sorry. It's not working either. Daggum. Okay. All right. Yeah. So we're solving for PMT. So equals PMT, right? So if we have an equals PMT, then we need to make sure that we give it the right information. Okay. So it needs a rate. So the rate is given to us in the first paragraph, 5.5% per year. Okay. But remember, he's making monthly payments. Okay. So if you got this answer wrong, and I don't have access to your actual Excel file because you guys uploaded the PDF like I asked for, which is great. But if you got this answer wrong, most likely it's because we didn't convert to monthly compounding. Okay. So go back into your Excel file and look at your PMT function and make sure two things are happening, that you're converting the rate to a monthly and you're converting the years to the total number of compounding periods over that 5-year period. Okay, 5 years or 7 years? 5 years. So make sure you're converting the years to months and make sure you're converting the rate to months. Okay. He's making $1,000 initial investment and he needs to save $7,000. So you've got the PV and you've got the FV. So if you made a mistake, chances are you just didn't convert the months and the rate into monthly numbers. Okay. So the PV is negative 1,000 because he's making a $1,000 contribution. And the future value is $7,000 because that's what he's trying to save. And then you've got the rate and you've got the number of compounding periods. And for the most part, everyone else, like on the, just on the more subjective questions, everyone had good logic as to which one, you would recommend, Albert take. All right. The next section. Taxes. First thing, some of you didn't convert the numbers to annual numbers. You've got to convert the numbers to annual numbers because the 1040, the tax forms are annual numbers, not monthly, but annual. Okay. Then we have to apply the percentages for the 401k contribution and the HSA to those annual numbers based upon the wages and wages only, right? Because when you contribute to your 401k or your HSA, it's based upon your earnings, okay? Your wages, not based upon your wages and the dividends that you might get from your investments, all right? Your 401k and your HSA are simply tied to your annual wages, right? So we take the annual wages and we multiply it by whatever rate, in this case, 15% for the 401k and 2% for the HSA. That gives us the numbers for our 401k contribution and our HSA contribution. That's what goes on Schedule 1, Part B. Okay, those are deductions from income, right, that reduce our tax obligation. Right? So we have gross wages on an annual basis. We have annual ordinary dividends. The two of those are our total income. We go to Schedule 1 for deductions to income, which would include the annual amount we make to our 401k based upon our gross wages, excluding dividends, HSA contributions based upon our gross wages, excluding ordinary dividends. And then we have the student loan interest deduction, okay, at 150 per month. So we have to convert that to annual, put that in Schedule 1, Part B. All right, so there's only 3 parts that you have to add up that are adjustments to income. Okay, and that gets us down into the taxable income. All right, so again, chances are you made one mistake in one of those categories that led to, you know, a number of mistakes that showed up on your graded answer sheet. Okay. And then the tax calculation is the marginal tax brackets, like we talked about, right? First layer is at 10%, second layer is at 12%, third layer is at 22%. It looks like most everybody figured out, right, that Albert was in the 22% tax bracket. Okay. So I think that if you made mistakes that led to like 6 or 7 wrong answers in that section, it's one mistake that kind of flowed through and killed you on everything. All right. The next piece, for the most part, dealt with the credit card interest and the number of periods and how to calculate the number of periods. I'm going to try to see if I can't share the screen again. Okay. So let's think about how Excel sees numbers, right? We talked about why Excel likes to see the present value as a negative, right? This cash out. But that's if we are investing our own money, right? That's if we are taking money out of our pocket and putting it somewhere else, correct? So if Excel needs to see the right sign to calculate the numbers properly, and we have an outstanding balance on a credit card, which direction should the sign be on the present value? If we have a loan, if someone has given us money and we're having to repay it, what sign does the present value have to be if Excel is going to calculate the right number of periods? Kiara, I know I can see your brain working.
Like, are you asking if it has to be positive or negative?
Yes.
Would it be negative?
Remember, negative implies from our own personal life, if we're going to invest our own money, right? That's money coming out of our life and going into some other investment. So yeah, Excel sees that as negative. But in terms of a loan, if somebody is giving us money, right? So technically a credit card balance means that someone has extended us credit, basically has given us money, right? So what does the sign need to be for PV in questions 17A and B? We have a credit card balance. We're trying to figure out how many months it's going to take us to repay the loan. So people have given us money. So we have money coming into our life that we haven't had to repay yet. So therefore, the sign on the credit card balance representing PV needs to be what? There you go. Easy answer.
Positive.
Yes, thank you. Okay, so we got to think about how it, not only how, in the context of the problem, but how Excel sees the cash flow, right? So if we're making the investment, that's money coming out. So we're putting money into a brokerage account. That's cash out. So questions 1, 2, and 3. Traditional, classic, money's coming out of our life and being invested. Question 17A and B deals with credit. People who are giving us money, right? When you get a credit card, they're saying, hey, you're trustworthy enough to go and I'm going to give you a credit limit. I'm basically giving you whatever, $5,000 for you to go spend. So when you charge that Gucci purse, all right, the credit card company is essentially giving you that money right away in order to buy that item. And so in the context of Excel, okay, when we talk about loan payments, whether it's a car, whether it's a credit card, whether it's a mortgage, okay, the present value is actually a positive number because it shows as money coming into our life. Okay. And if he's making a payment, if we're making a payment against that balance, right? If we're using the equals NPER function, okay, we know the present value is whatever the balance is. We know the future value is what? Because we want to pay it off. So what's the future value? 0, right? Bagel, exactly. Okay. So we know it's a 0. So we got the present value. We've got the future value. We know what the rate is. Okay. And so now we can calculate what the number of periods are using the NPER function. And we know that we have to adjust for monthly compounding, right? Because it's a credit card payment. We make payments every month. Okay. So my guess is that where you made the mistake in question 17A and B is on the signs, okay, on the actual plus and minus of the PV. Okay. And not in the actual understanding of the formula that you were putting into Excel. So adjust for your compounding because it's monthly. So you've got, remember to adjust for compounding, all right, on the rate, and then make sure that you've got the present value plugged in properly. And then make sure you have, now what sign does the payment have to be when you plug the PMT into the function in Excel? For 17A and 17B. So 17B tells you he's only going to make a $75 a month payment. So keep your signs right. Think about cash flow. In the context of the credit card balance, the credit card company has given you money. They've allowed you to go and buy whatever it is that you bought. They've given you money and you have to repay it. So you have money coming into your life as present value, and then you have money going out of your life in the form of what? A monthly TikTok, Mr. Wick. What do we pay every month? Or what is Albert paying every month on his credit card? His payment, his monthly payment, right? So from the very first page, he's making a $200 a month credit card payment, right? So that represents the PMT variable within the NPER function. So use the NPER function and simply get your signs right. That's it. And you'll be fine. Okay. And I really wish that my screen share was able to work right now because I'd go through an example with you. Anyway, all right. So what I'll do to kind of compensate for my inability to share screen because I'm getting this error code, I'll record a separate little video, right, that deals specifically with questions 17A and 17B. So calculating the number of periods required for a loan. So I'll record that once we get out of here, and I'll upload this as well as those short videos to the YouTube channel after that. Does anybody have any questions about the midterm that they would like to discuss? Oh, also too, if you got points taken off on question 18 about the SMART goal, the reason why you got points taken off is because of what I asked you to do. Give me an S, give me an M, give me an A, give me an R, give me a T. Give me a SMART goal. Okay, some of you just kind of wrote a sentence out that was like half smart or a third smart. Not that it was terribly bad, but it needs to be smart. Okay, SMART. So if you got points taken off, just go back and give me a discrete objective for each of those 5 letters. Okay, SMART. Just going through my notes here from grading. Everybody did great on the last question, difference between a tax deduction and a tax credit. So that was awesome. Okay, anybody have any questions? No? Okay. All right, so let's talk.
Actually, I did have a question real quick.
Yeah, go ahead, Elijah.
So I guess my question is, if you're not satisfied with the score that you got in the exam, is there like any way that you can kind of like make up that in a way? Like not in a redo type sense, but like, is there anything like any options available that we can use to kind of like maybe undermine the score, I guess?
I'm giving you the option of going back and reworking the questions that you got wrong, and you'll receive full points back if you do that.
Okay. What's the due date on it?
It'll be due next Thursday.
Okay.
So I'll have another folder put up on Moodle, and those of you that would like to resubmit, I mean, whatever, if you got one question wrong and you want to boost your score to 100, do it. If you've got 10 questions wrong and you want to boost your score to 100, do it. I'm going to give you the opportunity to go back and just rework the problems that you missed.
Okay.
Because I have a feeling, and that's, many of you that, got a much lower score than you were thinking that you got, it was a result of one mistake. And then that one mistake carried through to 5, 6, 7 other different questions. Okay. So your math could have been totally right, but you made one math mistake at the very beginning and it flowed through everywhere. So that's a life lesson, right? That's kind of why I do what I do. All right. So if you go back and you rework the problems that you got wrong, chances are you fix one thing and then everything else gets fixed. Right. But I will give you full points back for every question that you got wrong that you subsequently get correct. Okay? And you've got a week to resubmit it.
Okay.
Okay. All right. Anybody else have any questions about the midterm? Seems fair. I'm probably like the most fair professor you guys have ever had. Okay, let's talk investing. And this is where I'm gonna start asking questions and I'm gonna need some feedback. Why do we invest our money? Why does the stock market even exist? And if you don't feel like talking, I can open the chat room and you guys can hit the chat room if you'd like to hit the chat room. But why does the stock market exist? Why do we have this giant casino that millions and millions and millions of people put their money into?
Is it because they expect to get some sort of a profit back from investing or something?
Okay, so they're expecting a profit, but there's lots of places that we could put our money, right? Why do you think the stock market was created to begin with? Why do you think companies decided to, quote, go public, if you will? Dean says, so they can see a return in the future in return for their investments. Okay. Right? To potentially build wealth, good. Capital markets. Okay. By going public and by selling shares into the marketplace that people are going to buy, you create a connection between the product that is sold and the company that makes it and the shareholder that wants to get wealthy. So the singular purpose of any financial manager at any company, whether it's publicly traded or not, is to generate shareholder wealth. Okay? Every decision that gets made, right, in the corporate world is designed, should be focused on one thing and one thing only. And that is building shareholder wealth. Okay? And we could also apply that to your personal life, right? Every financial decision that you make, which is pretty much every decision that you make, should be designed to build your net worth. Okay? So when we equate your personal finances, my personal finances, to the corporate world, when I say corporations should build shareholder equity, shareholder value, in our personal life, what we're saying is we want to build net worth, right? So we go back to the financial statements and we invest our money into 401ks or Roth IRAs or in CDs at a bank or whatever, even in a savings account at a bank. We do that because we want to increase our own personal net worth. We want our assets to be larger than the liabilities that we have. Okay, so in our personal life, it's no different than it exists in the corporate world. Every decision that financial managers make at, whatever, 3M or BP or Netflix or Apple or any company, their entire job is to build shareholder value with every decision that they make. And it's the same thing in our personal life. We could choose not to go to Starbucks today, right? And we can make our own coffee at home, Death Wish coffee, great coffee, right? And it costs about half as much as going to Starbucks probably. So we have choices in our life that each choice that we make builds our net worth, right? So our goal is to, over time, have our assets be significantly larger than the liabilities that we have. That's why we pay off our loans. That's why we pay off our mortgages. We build our asset side and we pay off the liabilities. So why do we invest? Well, because we see risk and reward, right? And we should always be rewarded for the level of risk that we're taking. Okay, so if we keep our money safely in a bank that pays us very little interest, okay, it's safe, right? You're pretty much protected up to $250,000 You get reimbursed if the bank toes up. Okay, but it's essentially zero risk. And so in return for taking no risk, you get a lower interest rate. So the rate that you get on your savings account in the bank is like 0 point nothing right now. Well, it's probably a little higher than that because Fed just announced another 75 basis point increase yesterday. But it's still not a lot. Okay. If you want to take a little bit more risk, to get a little bit more reward, maybe you invest in US Treasuries. Okay. Where the 10-year note is like a 3% return. But your risk level is still pretty low because the default risk is tied to the US federal government, right? So the likelihood that the federal government is going to go bankrupt is pretty low. All right, so you're looking at a 3% return. And then you've got additional options, things that we call fixed income or bonds, okay? Where you make an investment, and in return for making that investment, the bond issuer agrees to pay you a certain amount of money every 6 months, called the coupon payment. But it's backed by the full faith and credit of the company that issues the bond. Okay, so it's a debt. You own part of the debt of the company. And then we move into equities, the stocks, if you will, where companies issue stock in the marketplace, right, in order to generate wealth. Okay, the equity that shareholders have within a company is a liability to the company. They owe that to the shareholder, meaning that if the company wanted to take themselves private, so to stop being publicly traded, okay, they would have to buy back all the shares on the market. Because who owns all of those shares? The shareholders. You do. You own part of that company. And so if the company doesn't want you to be an owner anymore, they have to buy your shares from you. So that becomes a liability for the company that issues stock. So getting back to the original question of why do we invest our money in the stock market, it all gets back to risk and reward. Can we earn a higher level of return by putting our money into this casino, trusting the companies that we invest in to do the right thing, trusting the managers of the companies to do the one job that they have, and that is to increase shareholder wealth? Are we willing to take that level of risk? Because I have seen time and time again, companies who look really good on paper, but then their stock price goes to zero and you lose all your money. So it all gets back to what level of risk are you willing to take? Okay. And there's a lot of opportunities in the marketplace to generate significant returns. I mean, look at Tesla over the last 5 years. Look at Apple over the last 30 years, Microsoft over the last 30 years. The question is, are you willing to stick with it? And do you believe that the historical patterns in the market will play into the future? Okay, so when we talk next week, we're going to start getting into what is a bond, what is a stock, why are they priced the way that they are, time value of money, future value, present value is going to come back in a big way when we talk about that. Okay? But why do we invest? Why do we put our money in the stock market? It's because we believe that we are able to get a higher return on our investment than if we had simply left it sitting in a bank. And the government has given us a number of incentives to save for retirement. So things like the 401k, things like Roth IRAs, things like traditional IRAs. The government has given us these options, okay, to help us save and save on taxes for our future eventual retirement. Okay. Now, what kind of funds are available to you in retirement? What do you get in retirement? Social Security, right? Supposedly, we'll see how that works out, right? But we have this massive program called Social Security. You know, every paycheck that you get, you are essentially contributing to this giant pool that is paying out money to people who are currently taking Social Security, right? Your grandparents, right? Whatever you're earning right now, this is serious. Whatever you're earning right now, a portion of what you are contributing to Social Security is going directly to your grandparents who are accepting Social Security. Okay? So we have this big pool called Social Security. And the government said, that's probably not going to be enough for people to live on. So we're going to create these retirement incentives, right? These other programs that we're going to make available to employees of companies, called the 401k, called the Roth 401k. We're going to give individuals a couple of opportunities in the form of a Roth IRA or traditional IRA so that they can get some benefit now, lower taxes, tax deferred situations, so that the entire burden of funding an individual who's in retirement isn't necessarily on the entire government. We're going to give you currently today incentives to start saving for retirement so that the system in the future is not as burdened as what it would be if those incentives did not exist. So we invest because we know that we can get a higher return in the market as opposed to in a bank. But we also invest because we don't really know if the government is going to be funding Social Security at the level that we're going to need it to be at when we retire. So we're kind of taking matters into our own hands, if you will. So starting next week on Tuesday, we're going to talk about how we go about designing portfolios. Why is it important for bonds to be a component? Why is it important to have stocks? Okay. You can hit the chat room on this next question, but how many of you guys have taken statistics, at Loyola? Yeah. Okay, Kiara. All right, Reagan. Yeah. Okay. So we're not going to get into the calculations of standard deviation or variance or covariance, but we're going to talk about why that's important. Okay, we're going to talk about how those relate to risk and return, because we're going to go into the Morningstar site, all right, that you guys have full access to, and we're going to dig into, all right, here's a lot of numbers. Like, what's important and what does this mean? Because Reagan, when you got your employment packet or getting your employment packet from Fox News, you're going to have to select what investment options you want in your 401k plan. You're going to have to say, I want 10% here in this particular mutual fund. I want 5% here in this particular mutual fund. And for the next couple of weeks, we're going to talk about how you go about figuring out what's best for you. Okay, so you're going to hear terms like standard deviation. You're going to hear terms like Sharpe ratio or alpha or beta. We're not going to have to calculate it. If you take my corporate finance class, you'd have to calculate it. But the concepts of those are very important because it allows you, like we talked about the very first lecture, how you personally feel about investing is different than everyone else in the class. And how you feel about investing and how much risk you're willing to take is different from everybody else. So how you choose to allocate your 401k investment will create a certain level of risk profile for your own personality. So that starts next week. Okay. What questions do you guys have? Anybody? Sorry about my screen share. Let's see if I can't do it again real quick. Oh. Right. Any questions? Nope. Okay. All right. So that'll shut it down for today. I'm going to go ahead and get another short video put up to the YouTube channel that deals specifically with loan payments. All right. And calculate the number of periods based on loans, right, with opposite signs. So you guys can review that. I'll put a folder up on Moodle for you to resubmit by next Thursday, if you'd like to. Okay, it's totally up to you. Choices are good. As my wife tells my daughter, girls have to have choices. All right, so I'll get that done. And if you've got any questions, just let me know.